Thanks so much for being with us, Justin. Really glad to talk with you and chat about and hear your expertise. I know you have been already a huge resource for Housing Hub and some of the research that we're doing to understand attainability with single family housing, and then also just a resource for clients. So glad to have you here. Want to invite you just to tell us about your mortgage professional job, what you love about it, or even how you got into the world of mortgages.
Yeah. Thanks, Julie, for having me. So the way I got into it, I guess you could say I fell into it. I've never met a high schooler, and my wife has me come to career days and talk to her class. I've never come across the teenager or the young person that's like, I want to do mortgages when I get old. I didn't even know what it was. I didn't even know what in the world I was doing. So I went to UT Knoxville. I graduated in football. It was great times up there. And then when I graduated, it's like, oh, I got to get a job. Like I'm getting married, I got to get a job. And so, kind of fast forward, I ended up just in banking in general, in consumer banking. And when I got the job, banking, the first step as a young married person was, hey, let's buy a house.
Yeah.
And I bought a house and I signed 80 pages of documents only to know that I had no clue what I just signed. I
Mm.
had no, I knew what the payment was. I didn't know where my down payment come from. I didn't know how closing costs work. I didn't know any of that. And so after I got more experience just within consumer banking, that if you visit your local offices, the ones who help you with checking accounts or personal loans, I got more experience with that. I started digging into more of a mortgage and understanding the process of a mortgage, understanding what it was and understanding what all avenues were out there. And so when I was about 5 or 6 years into the consumer banking, that's when I made the switch and I started more so dedicated to one product, the home versus multiple products. And so yeah, that's kind of how I got into it, and then been into it now for almost, I guess I've been in finance for 20 plus years now. So
Great experience that you brought, just getting in that single lane of expertise. It's just, I know that we benefited, like I said, organizationally, and sending clients your way with just kind of your breadth and your tackle of let's put a plan together. So it's not actually about let's sign on the dotted line, but let's put a plan together to get somebody to a mortgage that I really, really appreciate. So your introduction into the world of home ownership sounds kind of typical that you and I hear in this world, that folks are like, okay, I got to buy a house, instead of backing up and figuring out what that entails to purchase a house and all of the big ball of wax that goes into that, and maybe even signing something that folks are challenged by. But there are lots of, and I guess the way we've set up how we prosper in the US, it's right, there's this pathway, and then purchase of a home is part of that pathway. So there are some pros to owning a home. What are your top
oh yeah.
pros?
And I'll kind of relay this back to my personal experience. I didn't have a clue what was going on. I did have people that I trusted around me. I still didn't have a clue what was going on, so I did rely on their expertise. I relied on them to guide me and to advise me. And then, after the fact, I guess I learned more about what I had just done, right?
Mm.
However, had I not at least made that step forward, I would have caught myself still in a situation of potentially renting. And then even renting, we're just, if you don't have a plan in place, and I'm not saying renting's bad, but renting should be short term all the time. Renting should be short term. I would have been stuck in that situation of wondering how to get there, how to get there.
Yeah.
So the way it felt for me, it gave me that opportunity into the first experience with home ownership. And unfortunately, there were learning lessons, but we all have learning lessons in life. But it turned to prove how I could scale up to the next home, into the next home, into the next home. And so for us, the first home that we bought, it was the dream home for us at the time. It was not our permanent home. It wasn't our final home. And I think a lot of people, when they go into it, you have to understand more than likely your first home, you're going to live there for a short amount of time. But for our intentions, it worked for building the equity to the next home. And so after we lived in it a handful of years, we put our touches, we did improvements to it. Then that's what it proved to us. We were able to live in there for approximately close to what rent would be at that time. So we owned something though. And so the value increased. And then when we sold it, we were able to take that and move into the next one. I think that's what homeowners need to understand is the first step is number one, your first home, very, very unlikely you're going to live in it forever. I mean, there's a few circumstances, very unlikely that's going to happen. What you want to focus on, is it a good purchase? Is it within, range? Is it within market? And seeing what we've seen in the market, historical appreciation for the past 80 plus years is around 5%. So if you consider that 5%, that is how majority of homeowners get to the next home and to the next home is they start with that initial purchase of not the dream home, but
Right.
of the home that works for them at that time.
Yeah, it's a good investment. So equity, tell us what equity is.
Sure. So equity is the portion of what you owe against the home and the value of the home. So if you owe $100,000 and your home is worth 200, you have $100,000 of equity. And then that equity, when you sell it, and let's say you sell it for 200,000, and after you pay miscellaneous fees, commissions, all those are 20,000 as an example, then you have $80,000 now as your down payment to put towards that new transaction. And so that's how that equity becomes powerful in allowing you to build your wealth and continue. Like I said, if you bought a $200,000 home and assuming appreciation's 5%, well, it's just like having your money in a savings account, having your money in a 401k. That is an asset to you. So with that 200,000, the next year at 5% is now worth 210,000. So you're taking that value times that appreciation, and that's historically how homes increase in value over time.
Yeah, yeah, it's such a smart investment. So the other thing that I love too about home ownership is that the stability it brings both for like the family who gets into the home, but then also like our community as a whole. It's is a bit people are more stable, families are more stable. What you're paying in housing costs can have more stability. So you mentioned rent. Heard a person connected with Habitat give this presentation about like just historically the trend of rent. Rent is always going to be rising. Housing costs are as well, but once you are locked into a mortgage payment, you have a reasonable understanding of what your housing costs are going to be right there with that mortgage payment over a longer period of time than worrying about like, I can't tell you how many clients come in to see me and they're like in a situation like, well, we're renting a house and we just heard that our landlord's going to sell, and so now we're stuck finding some other place to rent, which is, I think, a current challenge of the housing market. Maybe it's always been that way around here, but definitely currently it's a little challenging to find rental units as well. So like that sense of stability over the long haul, and we don't think about that often, right? We think about like purchase, like the price of things, like what is it going to cost me? What is it going to, I'm going to be less able to move places, or the things you're giving up, because we can't really put a monetary value on that stability. But I see it so much helping families grow. I mean, like, did that for your family, right? Early on, getting into
Right.
into a house, yeah.
Yeah.
Um, let's talk about some challenges, though. What are those? Because that's kind of the place that we live too. What are the challenges in owning a home versus renting?
Yeah, so obviously when you own that home, it's yours. You're not calling a landlord, you're not getting anything like that. So it is your responsibility. And so I always tell clients like you have to be prepared. Like you gotta know if you're going in, and I don't care if it's a new construction. Home ownership comes with a cost. There's going to be the issue that the refrigerator leaks and it was unexpected. You've got a deductible. If you got insurance, that's great, but you have a deductible that you have to fulfill. So there are going to be challenges, but there's always challenges, as you just mentioned. If you're in the rental world, you may have a terrible landlord. You may have. I had a client that I helped finance a home, And she was like, I've got raccoons living in the attic that they won't do anything about. So you're always going to have a challenge. It's what challenge do you want? Do you want something that's within your control or something outside of your control? So, but it's always smart to be prepared. You want to make sure to have some type of an emergency fund set aside. So, challenges right now with home ownership is obviously the affordability that you and I have discussed many, many times. But what we're finding, going back to your rental discussion, is that you may have a family that have had a landlord for a long, long time, and they have this way below market rent, $700, $800, and they think that's the norm. But that landlord or the new landlord, once those people are out, very likely it's going to a minimum of $1,300. Like, I don't know any in the area. I don't know any home that is under $1,000 rent currently. I don't care if it's two
I don't
bedroom,
either.
anything,
Yeah,
and
I was
and that
thinking
would
the
be a
same.
bargain. That would be a
Yep,
bargain.
absolutely.
And so I think the unfortunate thing is people have to be realistic in today's time. They have to be realistic into the affordability. Everything's went up. Everything has went up. But when you're looking at what it takes to afford a home, and you're in a scenario that you've been living, you've that landlord, they were in at a low cost. You paying them $700, they were still making money. But I have had the conversation with the client, says I got to be out in 30 days. And then we have to have the hard conversations. What's your budget? Well, I was paying $500 a month. And I'm like, you can't even cover taxes and insurance for $500 a month, in some certain circumstances. But so there are going to be the challenges. That's why it's very important to plan. I don't care if you're renting and you just signed a lease. If you signed it today, you still need to have a plan, because the budget is important. You have to make sure you know your affordability. Not only that, you have to make sure you're aware of the market to know, okay, if I buy a $200,000 home, my payment's going to be about $1,700 a month. So how do I account for that? How do I allocate my budget? Do I pick up a side job? But those are the common challenges right now, is the
Yeah.
affordability part of that. But home ownership or renting is both going to come with challenges of living in the property. It's just a matter if you want to take control of it yourself or rely on a landlord.
I love that frame though of like, you're going to have a challenge as rental in a rental unit, and with knowing, having the control over and knowing the systems that you're in your home, like how the HVAC works or how old the water heater is, those sorts of things. It's funny, this morning before leaving for work, in my household, we were discussing the maintenance of the P trap in the kitchen sink. Like
It's part
there's,
of it. Those
yeah,
things are
exactly.
disgusting to
It's like,
clean out.
it is like, oh, I have to do that every 3 to 6 months. We need to be doing that. So yeah, no, it is funny when you get into home ownership. One of the things we do at Housing Hub too is try to help folks with a maintenance log with your house. So like, here, let's introduce you to what you have here, and think about like roofing material is on, and so that means 20 years feels like a long time from now, but in 20 years, that's a big chunk of change if you got to replace your roof. So,
It
like, just
is.
having it on the radar even
Right.
can help with. And then I also too think about, you mentioned mentioned some initial cost of getting into home ownership that people kind of overlook, or we discuss, have just one pot of savings, and that's early on in my coaching. But after we talk about a spending plan, how healthy is your credit, the next question is, what kind of savings do you have? And that's something like in your plan, like you can do now, even if home ownership is years down the road. Do you have an emergency fund already? Then do you have money for down payment, closing? There's going to be something. You say that to me all the time. You're going to be bringing something to closing when you're buying a house. And it's not just your tax return amount, right? It's going to be something more substantial than that. And then also and then the home maintenance, like being able to shift your budget, your spending plan over to understand that. The other thing that I think I've heard you say this, and it's okay if you need to give credit elsewhere, but
I'll
this
say
is
it
really
now.
great.
Let's see.
Yeah, this really great tip of don't time the market, time your finances. Can you explain a little bit about that? Don't time the market, time your finances.
Yeah, so I'm a perfect victim of trying to time the market. I've missed out on deals before because I was like, this is crazy. It's too much. It's too expensive. All of the time I could have done it, but I didn't. And then the next thing you know, then the value goes up, the price goes up, and I kind of missed it. So a lot of people right now, we need one of those. Julie, have you watched the movie Men in Black? I'm sure you have. Okay, you know the little flasher that and they flash and you forgot all what happened, right? Okay, that is what we need for what happened in 2020 and 2021. We need that flasher because the young generation expects a 2.5 to 3.5%. And I mean that generation that's relatively, in their mid 20s, upper, close to 30. They just expect that. That's what they lived through a couple of years. Now we've had previous rates in the threes, and then it happens. It's all a cycle. Historically, we are at historic average interest rates right now.
Yeah.
And so, from that standpoint, I tell all my clients, I do not lead out with the question, what purchase price are you looking at? Because they have no clue what goes into the payment. My first question is, what is your budget for a house payment? And then we work from there. We go from there and we decide where that's at. And the reason in regards to that is timing your finances is because if you wait on the market, I mean, who would have told you what would have happened between 2020 and 29 and now? We have homes that have tripled in price. So if you were timing the market, because then here was the storyline then. Storyline was the interest rates were great, but you were paying in some of the markets $50,000 over the asking price. You were in bidding wars. Pick which one. Do you want to go into a market where you're paying $50,000 or $60,000 more with a 2.5-3% rate, or do you want, now we're almost at that level where you can negotiate depending for the seller to pay your closing cost. And so you have to pick, but at the end of the day, they have to make sure that that payment is within their budget. At the end of the day, you have to consider, can I make this payment based on what's happening today? Because here's the thing, worst case scenario, we've locked your interest rate in at, let's say, 7% standard market right now. We've locked it in. That rate's not going to change. Your taxes and insurance might. The rate's not going to change. If the rates go to 9%, you look like a genius when you did it, okay? If the rates come down to 5, which I'm hoping, I'm praying for, I'm looking for, if they do that, then people are going to be in the habit of making the payment on 7%. And one of two things have happened in my career when this happens. Number one, they're going to refinance and they're going to save a few $100s a month, and it's going to be nice. Number two, they're going to say, hey, that payment's fine, and we're going to refinance them down and shorten the term of their loan. So we're going to take their 30-year probably down to a 20-year, maybe even a 15. I had it a few years ago where I put people on a 15-year for what they was paying their 30. They cut that loan term in half. So that's why it's important. If it fits within your budget, someone messaged me the other day, said, we've been kicking around the button, is now the time to buy? And I said, is it within your budget? Is the payment within your budget? If it is, then yes. If it's not, then no.
And that feels way more freeing when you say that than it does. I've got to keep my eye on the market, or I've got to keep my eye on what's coming available on the market and decide, am I going to buy now because there's a house out there I want to buy? But I'm getting yourself fiscally, financially fit first, and then you're poised to, click the button when it's right, rather than waiting for the market. I also like that that perspective on, because we're in this version of the housing crisis because of the 3% rate versus what is normal. And so you just said, understanding reality. I think that's what it is. Historic average interest rates. Like, that's reality. We're in reality. This is real.
We are. We are.
3% was not real world. And how that has created the situation or added to the situation we're in. We could go down that pathway too. So my question there, I said the goal of our conversation for me was, how do I know if I'm ready to be a homeowner? Part of that has to do with thinking through what is home ownership versus your living condition state now. But the other thing is, like, what's my budget? That's the big financial question, right? What is my budget? And then working backwards from that. If you want your budget to be more than it is, then you're thinking about how can I change income, right? What can I do about that? I have clients too that, you ask that question about what's my budget, what I want to pay, making a house payment. And then all of a sudden they're also thinking about other things that are maybe less stable in their lives that they want to
Mm-hmm.
tackle first before, thinking through like, oh, I need to make sure my transportation, like I want to have a reliable car to get to my job, or I want to consider a change in, change my job. And then maybe that means you're putting off home ownership a little while, but you're making those kinds of, answering those kind of questions to make sure you're in that, being fit financially too. Okay, let's change gears a little bit and talk about your top tips. I know it's always, I don't like saying what's the one thing because there's usually like 5 or 6, or it's, more
Right.
complex than one thing. But your top tips to know, to be ready to talk with a mortgage professional. So if I was coming into your office, what would make me ready to sit down and have a conversation with you?
Sure, yeah. So a lot of times you look at it and there's a few acronyms some people use, but so obviously number one is going to be your credibility. Have you established credit? Have you been building your credit? Are you someone who chooses not to use credit? But so around all of that, there still has to be a plan. So, for example, if you're someone that, and here's the thing, is I think if you manage credit responsibly, it's just the game. It's the game that we play. Okay. I don't recommend anyone to go get a credit card and charge it up to the max. That's not going to help your credit. But if you responsibly use a portion of that and you pay that off, that's fine. If you go to the bank and you get a small loan and you pay it back, that's part of building responsible credit. Now, if you go to every department store that gives you 10% off and you max out the card, that's not responsible. So it starts with credit. What people need to understand is there's what's considered long-term credit in the mortgage industry, and that's generally 12 months. So a lot of times when the system is reviewing the credit analysis, they're looking to see how many trade lines did they have with a 12-month payment history. If you have multiple trade lines with a 3-month and 6-month, and a lot of times these are like finance places that people go into and then they go make a payment and they talk them into refinancing it. They think they have credit, but they've never established long-term credit. So from that standpoint, it's very important credit-wise to have what's considered long-term credit, which is 12 months. Ideal is to have about 3 trade lines of that. So if it's someone young and they've got a job, I say, hey, go to the local bank, see if they can give you $1,500 and pay it back over 12 months. So you want to be responsible. You don't want to max out credit cards. Don't go get a $700 vehicle payment off the get-go. You're not ready for it. If you can't get into a house, let's scale back on buying a
Yeah.
brand new vehicle. Unfortunately, I see that quite a bit. Some people, though, they don't want to use credit. They've been taught not to use credit. They don't want to use credit, and that's fine. We use what's called alternative credit. But what you need to know is you limit yourself on the options that are available when it comes to a mortgage. Okay, because most mortgage guidelines are written around credit. They're written around verifiable credit. And so you limit yourself into maybe opportunities that you would have, maybe interest rates that you would have versus having a good credit score and no credit whatsoever. But if you choose to do that, that's fine. The one big thing, so alternative credit is going to be 12 months verification of things that would not be showing on your credit report, such as a verifiable rent history. What do I mean by that? I mean, just because you can get a receipt from your landlord is not justifiable in a lot of cases. Because, Julie, I can go to Dollar General right now and get a receipt book and write anybody 12 months of receipts. So, what do we transfers like Venmo transfers that are validated, just bank transfers, canceled checks for the younger generation that don't know what that is. That's something on a piece of paper that you write out, you know, but canceled checks, and these need to be consistent month to month to show where those come out. And then beyond that, depending on your landlord situation, it would be things like utilities. Is the electric in your name? Is there 12 months? We can usually get that from the local electric company. Internet, any type of utility like that. So we would have to compile 3 to 4 of those alternative trade lines, rent being very, very important. Okay. Rent being very important because that's proving that you know how to make a housing payment, choosing to have no debt whatsoever. So it's possible. It limits you when you choose to go that route. So the credit is one big thing. Employment is the next thing. So we call that capacity. Now, here's the rule with employment. We're looking at a 2-year history, okay? Does not necessarily have to be the same employer. It makes your file stronger if it is, but we're looking at a 2-year history to make sure you've been working for the previous 2 years. Um, you do have to consider if you have what's called variable income, if you're paid hourly, if you're paid commission, if you're paid overtime bonuses, things like that. Those will require a 2-year history to be able to qualify you on that income to see if it's consistent. Do you receive it often, or is it just like a one time here and there? So the income's big. If you're a salary, that's great. Love salary people when they get paid the same check every week, every month. Those people are fine. And one thing to know about the employment is if you're in school, if you're going to a university, a college, or if you are going to a trade school and you get that certificate or that degree is actually used for the work history. So we can validate the time and that you finished that, whatever you were pursuing, and you finished that, and we can use that as part of the history. Now, just to clarify, that doesn't mean that if you finish a certificate and it took you 1.5 years and then you get a job that's an hourly job the next month that you're ready to go right then, because like I said, when you deal with variable income, then it can be a little challenging to get that on a shorter history. So that's the other thing. And then the other thing is what you mentioned before is cash. But it's having the ability for your down payment and closing costs. I have so many conversations with people and I'm like, okay, what did you budget to bring to the table? What did you budget for your cash to close? And a lot of people's like, oh, I didn't know I needed anything. Don't you offer 100% financing? And I'm like, well, we have programs that do. However, there's what's called closing cost. Closing cost is generally the responsibility of the buyer unless you can negotiate that with the seller. However, you still need to be prepared. If you can't, what's the solution? Where is it going to come from? And there's sources that you can get gifts from mom and dad and grandma and grandpa, but really as the homeowner, they need to really gear towards, because even if we structure it that they don't have to bring money because the seller paid the closing, you still need that emergency fund. You
Yep.
still need that money set aside for that rainy day that's going to happen with home ownership. So those are the big three things. You want your credit in line, you want your employment in line, and then you want to make sure you have that cash available, ready to go.
Do you 2 to 3%? Is that your closing cost estimate? Like, do you use any of those on the front end?
Do I use what?
Like an estimate on closing costs. Like, would you
It's
say
hard.
2 to 3%?
So there's a handful of fees that are related to the purchase price and to the loan amount. It's hard to use like on a 3%. If you're looking into the 300,000 ish plus, that's probably a good ballpark. If you're 200,000, 100,000, it may be more than the 3%, just because some of the fees, lower loan amounts, there's still some fees that are flat rate fees that would kind of prove that to be a myth. But I mean, in general, when you start getting to 300,000, that 3% is a pretty good rule.
What I was trained for was
Okay.
But you're right, because like you just take, if you luck out with less closing costs or none, you can just you're rolling that into your home maintenance. Your savings as they're already established, and that you're that much further along. I also love thinking about variable income, and for folks who want to use that as part of their purchase power. Like you've got to have a history and it be verifiable. There's no sense. There's no sense in trying to qualify for a mortgage that then you don't have the income for. Like, yeah, let's get you in a home, but then 3 months, 6 months out of the year, you're struggling to make the payment because your income varies, or you haven't saved, you haven't banked that extra income
Right.
ahead of time to get yourself through the leaner kind of months. And so, we have that conversation too with folks. So great. So credit, your employment, and then your savings, or being ready to do those upfront costs. So I know we've already talked through some pitfalls just naturally in our conversation. So any other though, when you see people coming in, they really get tripped up over, is there anything else that comes to mind?
So, just general things is to be aware of what your credit is. Okay, and sometimes people, surprisingly, there's not. And there's resources out there that you can utilize. I would tell you to be very careful using some of the paid subscriptions. One comment, and I'm not going to call out the certain vendor that does it, but from my understanding, the information on your credit is accurate. However, the score that they give clients is never accurate.
Yes.
And I tell them when they tell me they have that, I was like, hey, this is like throwing dart at a dartboard. Like, there's no telling where it's going to land because we pull what's called a tri-merge mortgage credit report. So our credit report is going to be different even if you go to a bank, even if you go get a car loan, there's going to be a difference within what we pull and what they pull. And so it's always important that you understand and you know where your credit's at from that standpoint. I'll tell you one thing right now for anyone that has student loans, make sure right now to keep an eye on your student loans because what we've seen is the student loans are now becoming due. And I don't know whether it's lack of notification, I don't know whether it's lack of receipt, but I have seen credit reports that someone historically would have had a 750 credit score that has dropped that credit score by 100 150 points
Wow.
because their student loans just recently showed that they were 90 days delinquent and they were like, I didn't even know this happened. And so if you have student loans, make sure to keep a check on them, log into your account, make sure everything is, you either know it's deferred or you know that the payment's due and you're making the payment from that. But and to kind of echo what you said in regards to the overtime, we don't typically like if I can qualify someone without it, I do. There's always a potential use. You have some companies that their overtime is as much as their regular pay, and those are consistent. But I do have the conversations. Someone's been on their job for 6 months, and they're like, "I get overtime." And I'm like, "You haven't been there long enough for us to
Right.
consider that." And you don't want to count on that because, like you said, um, who would have thought during COVID that we would have seen the likes of Nissan shutting down and Disney World shutting down and places like that shutting down because a lot of people had the confidence that, oh, I get it. I'm going to be working this and this. Well, the next thing you know, your hours are shifted and you're not even working a full-time shift.
Yeah.
So it's good to have it there as a compensating factor. I don't like it from a reliability factor, not because I can't qualify you on it. I don't want you to depend on it when you're making a house payment.
Right. Yeah. I was going to say that the mortgage companies, banks, the folks that I deal with, they want to see clients staying in the home and making payments on
Yeah,
that home, and
we're not real
don't want
estate investors. We
yes,
loan
don't
money.
want. Yep, don't want to deal with defaults as much as you don't want to see anybody, losing their housing situation. So I love that. So annualcreditreport.com, free to get your credit report, not your score each
Correct.
year. I've heard the great tip from my friends at BetterFi that you can time yourself out where you're checking the three big companies once every third of the year. So you're actually checking three times of the year. And if you take care of what's on your credit report, you're going to be taking care of your score as well. So yeah, folks, and let me just say too, like until I became trained in my job, there was a lot of this that I was unaware of that I felt like, I should have known this. I'm old enough. I should have known this. So, super great tips. As we close out our conversation, I just, again, want to reiterate the making a plan. So a lot of this just is about making a plan. And the more you work on that plan, the more aware you're going to learn, terminology. You're going to understand, instead of having to think like, okay, what is again the definition of equity, as terms are thrown out or as, you're sitting with your mortgage professional or you're in a bank, you're just understanding the stuff better and better that just helps in the long run. So making a plan, and I'm like would say, hey, there's a housing coach out here that would love to help you make a plan. We got mortgage professionals in the area that would
Right.
like to
Yeah.
help you make a plan. So doing all that. But anyhow, I just want to say thanks for your time chatting with us and being able to make this information available Really appreciate your efforts and your work. And
Yeah, absolutely. And thank you. I mean, I appreciate your efforts right now. We've talked about it many times. Just this affordability, and I guess one last tip, if someone is renting, I tell them all the time, like if they think they're ready to buy, maybe they're qualified, but they're renting and they can't get out. It's like, okay, if this is your payment or if this is your budget, but your rent's only $700, you need to supplement that into your savings account. If you're budgeting for a $1,800 or $1,700 payment, you need to make a habit, put that $1,000 in there. And so that's just one last thing. But no, I appreciate
yeah,
you, Julie. I appreciate your efforts. It would be nice to kind of see a more of a balanced affordability, because the hardest thing I have is having to tell that person or that young family, that because the agents, I always aggravate my agents. I was like, you guys have a great job. You show them a house and everybody's all nice and happy. And then they have a conversation with me and I tell them what the affordability is. And I kind of like,
not
you have to bring them
right.
to reality. And
Yeah,
so I hate that. But at the same time, it's information that needs to be out there. We don't need to avoid it. We don't need to
no,
ignore it. We just need to know how to tackle it to get
yep.
there.
Yep. Well, yeah. Thank you for that. Yes, make yourself the house payment. Pay yourself. Do that for yourself so that you're in that place of ready to purchase when the time comes. No, I hear you. I would like for us to be encouraged about tackling these big life things, that for people to know there are folks out there that are ready to work with you and make a plan and coach you along the way if that's what you need. And that the waiting to get to something, you think that it's delayed, you're ready to purchase, desire to purchase a home now, realize that you're delayed 12 months, that there's actually work to do right now. Like every month you're working on this goal, and it's just building habits that are gonna help you in the long run. So well, with that, we'll say thank you and chat. We'll chat soon again. So
Sounds great. Thanks, Julie.